Hey, everybody. Welcome to the podcast. Thanks for joining me here today. Well, we had the ECB rate decision. That was kind of the big news of the day. Of course, the Fed recently kind of jawboning, promising, but not necessarily doing anything yet. And the ECB, Mario Draghi, was supposed to come out and give his plan on what he was going to do to potentially inflate more and debase the currency even more, and to save Europe with his magic wand. And as you can see, the markets did not get what they wanted. Dow Jones down 92 points, was much worse, really cut those losses in half. Utilities were down. Transports actually outperformed today, which is the first time in quite a while they've outperformed. They were pretty much flat on the day. Oil equipment services down 1.5%, and really some of the things that were going up based on QE3, based on some type of big plan out of Europe, those were the things that got hit the hardest today, which makes sense. Semiconductors down 0.2%. The Russell 2000, again, outperforming, so it's kind of a strange day from that perspective. And if you notice on there, the VIX down 7%, very, very strange, to 17. So on a day where the Dow was down and everything was down across the board, you still aren't seeing that fear. And I think if you're a bull, that should be a concern, because the fear-based sell-offs are the ones that get the market bouncing back the fastest. So as you can see, the stock market here, based on the S&P 500, kind of turned around almost right where it was supposed to turn around, at the top end of this range we've been in really since late May, early June. And I don't remember a time this type of pattern that you're seeing here, this zigzag back and forth, has been it's really, I don't remember a time it's looked like this, where it's gone on this long with almost identical patterns, 3 or 4 days up, 3 or 4 days down. And it's continued that way. And so what should we expect tomorrow? I suppose based on this pattern, we would see a gap down in the morning, right, and potentially a lower close. But if that's the case, then for short-term traders, that would be the time potentially you buy. You keep your stop, right around here, and you buy and you wait till it gets up to the top, and then you start lightening up again until it breaks out either one way or it fails and doesn't come up and it heads back down. Something's got to give here, and I wouldn't have thought we would have been going through these trading ranges this quickly. But to get back to what really caused this, it was the news. The ECB rate decision came out about an hour and a half before the stock market opened, and at that point, the Dow Jones was up 80 points in the futures before the market opened. And then as those comments came out from Draghi that basically used the keyword that I think was may. We may do this. And so I think they're putting some type of plan together, but the market obviously, like we've mentioned, almost being a drug addict, was saying, no, we need that stuff now. I can't wait till later. So the stock market was up 80, the Dow futures, reverse course, actually we're down 80, gap down. This is at the opening today. You're looking at a 5-minute picture going back from yesterday, when the sell-off kind of started, going down here. And then it gapped down this morning, kind of rallied back a little bit, not much strength to it, and then we went down to new lows. And then we did get a close higher, and like I said, really cut our losses in half on the indices. But when you look at it from start to finish, we basically came right back to where the gap was. And the internals of the market pretty much stunk, and the reason why is because not only did we have intense selling, no demand for stocks. You had a lot of stocks that were, again, these cyclical ones, really having some trouble. And on top of that, the volume on the New York Stock Exchange was pretty heavy at 4 billion shares, and that's way, way above its 30-day moving average. The 30-day average has been around 3.5 billion or so, something like that. So this was a heavier day selling, and that's not what you want to see. Now, it wasn't a 90% down day, but it was about 80% or so, and that's still an intense down day, and that's taking into consideration that we rallied the last 2 hours of the day. So we're still not really to that oversold panic area, and I mentioned that based on the fact that the VIX didn't spike up. But also on top of that, again, when you look at this is an hourly picture of the S&P, so this kind of range we've been in, we didn't quite get down to the bottom. So we get this employment report tomorrow. Again, if that's a bad number, look for the stock market to gap down. If it gaps down and can find some support down in this area, then I think you have a trade on your hands where you can go and maybe, as opposed to buying some individual stocks, looking at some broad basket indices, the Qs or double Qs or something like that for a trade. Because again, it would follow the pattern. But if we don't get that and we get the stock market rallying after that because maybe it was a temporarily good number, then again, we didn't get oversold enough to flush everybody out today. So we're kind of in between. Now, tomorrow's jobs number, I think the estimate for Wall Street is around 100,000. Some people have 106, 110,000. So 100,000 is kind of the number. We're going to get 60,000 or we're going to get 200,000. That will determine probably tomorrow's at least opening what will happen. And again, if it's a bad number, look for that to turn the corner here and get down to the bottom where we potentially could get a long trade. Now here's your disaster of the day, week, month, and potentially year. Knight Capital. Knight Capital is basically a brokerage house, and again, this is similar to the BATS exchange problem. Remember, BATS wanted to go public on their own exchange. They had some issues, had to pull that IPO because of technical glitch, errors, whatever the case may be. Then you go to the flash crash, and then here we have Knight Capital, and again, they're blaming it on potentially the installation of some trading software that could have hurt them, and the stock was down 63% today. Not to mention it was down, I think, 30%, 35% yesterday. So this thing was about a $13 stock, which you can see barely doesn't even look like it's moving on here because of volatility in the last few days. But basically, it's a $13 or $14 stock. It is sitting at $2.58. And I put a thing out on Twitter today, and if you want to follow me, it's twitter.com/Carl Eggerss. I give the economic reports and just some things that I'm noticing throughout the day, so if you want to follow me on there. But one of the things I was commented on was, boy, I'd hate to be the IT guy at Knight Capital because apparently this was a software issue. But the bottom line is this company yesterday was down, went down a little further after Egan-Jones downgraded them. And so then they went down further, and then today it comes out that they've got, they've kind of quantified what this number might be. But the argument stands, okay, is this high-frequency trading, is it meant for liquidity purposes? Is it hurting markets? And again, we don't have all the answers to what caused the flash crash, and that's one of my main concerns. But if it's contained to this company, you see, then it's not the systematic risk, right? So there's some people that say, look, this company's taking a bath because this was their problem. They're going to have to deal with it, and hopefully they can get funded and can continue on operating. And this company's been around a while. Then those are the other people on the other side of the fence that are saying, look, this is a major problem across the board because at some point it's going to bring the whole stock market down if this continues to happen, these little incidents that seem to be just isolated. So again, high-frequency trading is supposed to add liquidity, but what ends up happening is it adds volatility, and it really makes the retail investor basically shy away from the stock market and say, you know what, how can I invest in a company that up until 2 days ago, this is what it looked like. Everything was okay, just bouncing around, no big deal, and then within 2 days the company almost gets wiped out because of just an error. And so this is going to continue to be probably more heavily regulated going forward. But anyways, the bottom line was yesterday, that's what caused some of the sell-off. And then, of course, today, Mario Draghi's comments or lack thereof or lack of action is what caused today's sell-off. And then tomorrow, if we get a weak jobs number, then look for more downward pressure. Now, one of the things I think investors need to be concerned about is the fact that for the most part, all these sell-offs have been pretty much contained in the cyclical names. And you've had things like healthcare, biotech, utilities, some of the REITs holding up very well. One of the stocks that I actually just sold today was Altria Group. I've held it quite a while, and like the yield, like the company, like the fact that it's not cyclical, nice and steady. But I think this thing has gotten a little bit overdone, and I'm looking for it to pull back, potentially only to this little black line here. If it does pull back to that area, then it's another good entry point. Same thing with Verizon. I exited Verizon, a few weeks ago, and you can see it's starting to struggle kind of at this 44 level, 45 level. I think these stocks, AT&T, Verizon, all the telecom stocks, have been a wonderful trade. They have high dividend. Some of them don't have much growth, but I think this could pull back and give us a better entry point at some point. So, but my point in telling you this is that some of these staples are starting to look rather, suspect, at least in the short run. Even utilities, which I've owned for a long, long time. Utilities a bit extended, and you can see yesterday kind of made this reversal where it made a new high, came back and made a low. That's not a positive sign, and it made it on heavy volume down here, as you can see. And then today followed through, again, came back a little bit, only finished down 0.5%, but didn't cause me to sell. But I'm just pointing out that if the stock market begins to get really nasty, it's going to spread out into not just the cyclical areas, it's going to spread out into some of these staples and these safe havens. So just be careful of that. Again, the only protection in a really nasty market is either to short, go into treasuries, or to have cash. And I think some people are very comforted right now because there are still places to hide out, but some of those are starting to look susceptible, especially those telecom stocks, which have really just ratcheted up too far too fast. I think something else to monitor, not just besides the staples potentially being vulnerable, but if you look here, this is the small caps relative to the S&P 500, and we're pretty much now at a low. It's the lowest we've been since back in early 2010. Now, I'm not going to say that this always precedes a stock market fall, because there's been plenty of times it hasn't given warnings. There's been plenty of times the stock market has fallen, while small caps were rallying. But it's just something to pay attention to, because it does show how much risk is being taken, especially, if you have a stronger dollar, which we've had off and on, small caps should be doing well. And actually they're lagging right now. So we have small caps lagging. You also have financials obviously not participating in rallies. And then we've also have transports that have been falling. And, the theory being if transports are falling, then the economy's falling apart. And, it's kind of strange. And I mentioned at the top of the podcast, it was one of the things that outperformed today, only down 0.15% based on the IYT, which is the iShares Dow Jones Transportation Index. And so you can see, but it does look like it's starting to roll over. And so that's a concern. But, the bulls would say, hey, look, we haven't had a recession when we've had housing starts turning the corner and when we've had rail car loads turning the corner and going up. And those are things that are positive, so how can we be in a recession? Definitely there's mixed data, but look, there's the only reason why the ECB is mentioning that they have to put some package together, and the reason that the Fed is talking about further quantitative easing, QE3, the reason they're talking about that is because things are so bad. They wouldn't be talking about that if things were good. So for those that say, well, we're not necessarily in a recession because look at this, this, and this, remember, the key to these markets, the way they move, is that it's not whether you're in a recession or not, it's the direction the economy is going. For example, if you're in an economy that's shrinking by 3% a year, which is a recession, and all of a sudden it shrinks at 1% a year, the stock market will rally even though you're still in a recession. On the other hand, if the economy is growing by 3% a year and it shrinks to growing at 1% a year, it's declining and therefore the stock market falls. So it's the direction. So whether we are growing by 0.00001 or we're shrinking by 0.0001, those are not much difference in those two numbers. One's got a plus in front of it, one has a minus in front of it. It's the direction at which you're coming from. When somebody says, hey, Carl, how much do you weigh? And I say, pounds, right? I'll give you my weight. Let's say I weigh 175. That's an average weight for me. Well, is that good or bad? Well, compared to high school, it's bad because it's going up. Compared to maybe 6 months ago, it's good because I've lost a few pounds. I've lost maybe 5 pounds just changing a few things here and there. So again, but which direction am I coming from? Before I answer the question, is it good or bad or not? So that's the important thing to consider. And the overall economy I see is marginally getting worse. And some sectors are getting much worse, and some areas around the world are obviously much worse. But marginally, things seem to be getting worse. The saving grace is, yes, companies are pretty healthy overall. valuations are reasonable. All of those things are there. But look, as I've told you before, if you have a PE of 14, even if it goes to 12, you're still going to lose a pretty hefty amount on your stocks. So cheap would be if the PE got to 5, 6, or 7, or 8. And so there is room for stocks to fall. So don't necessarily look at valuation and say that is the saving grace here. The economy is getting worse slowly but surely, and the stock market is deteriorating. So those are things that you still have to be careful of. And again, you saw what can happen when there is quantitative easing wanted and it's not delivered. In other words, empty promises by jawboning central bankers. The stock market takes a tumble, and that's what we saw. We saw big reversals in Europe earlier today. So, again, stay cautious, but I would say that if we can have another big downdraft tomorrow, being that it's Friday, if we have a bad jobs number and the stock market's down 200, at some point during the day, you might start looking at some long positions to go into the weekend. Reason being is because we would have had a pretty nasty down week most of the week, and there's going to be a lot of people covering those shorts. And again, at that point, I think you will see things a little bit on the oversold side. And again, if I bring up a picture of the S&P 500, if we get to an area, this is just to reiterate, in case you're just joining us, if we get to an area somewhere down in here, then I think we can come down, and that would be your entry point, and then hopefully we can bounce. And look, if you bounce there, you get 3 or 4 or 5% out of an index, and we could still be in this trading range, but it might be a good trade. So watch that number in the morning. Have a great evening. Don't forget carleggers.com, eggerscapital.com, Twitter, Facebook, Google+, all those we are on now. So thanks a lot. Talk to you soon.